Hello, good afternoon. You're watching Closing Trades on ET now. Our last 1 hour left for the trading session to end, and if it ends where we are, it won't be a very pretty close to the markets at all. Nifty has been declining for last 4 consecutive sessions, but look at the sharp cuts that we're witnessing today. Nifty, of course, is below the 100-day moving average, and it's the first time that it has happened in the last 5 months. At one point of time, we were threatening to go below 19,400. The day's low for now is 19,404 on the Nifty, and we've managed to hold on and bounce back a bit from there. Nifty mid-cap index, that is where the pressure point is. Actually, the broader markets are underperforming today. So the Nifty mid-cap index has slipped below the 50-day moving average. The first time it's happened in over 6 months. If you look at the small-cap index as well, that one is seeing sharp cuts. The only saving grace, if at all, today is the Bank Nifty, because that one is outperforming. And I say that because on a relative basis, that's showing cut of just 0.2% versus the rest of the indices, which are much deeper. A lot of stocks which are losing, whether it's India Bulls Housing, India Cement, Laurus Labs, LTI Mindtree, Amber, Finilex Industries, all of these names will come up. No real news flow apart from, of course, a couple like Amber as well as Laurus, which are reacting to earnings, Aisha. But other than that, it's deep red. The only solace, if at all, is we are not alone. Asia also, of course, was also on the back foot. US markets had declined, and then there was that safe haven rally with 5% coming in on the 10-year.
Yeah, absolutely. And you also got to remember that for us it's a truncated week. Tomorrow is a trading off. You've got expiry as well this week alone. So lots really to digest, and of course we're in the thick of earnings too. But having said that, out and out, even if you were to stack up how last week for us panned out as opposed to what the global markets did, we were the relative outperformers. But yeah, Laurus Labs, it's missed estimates for a 5th consecutive quarter. The margins, remember, have come at 15% versus a comparable of 28%. Lower CDMO sales has been dragging the earnings. So that really is weighing heavy on the stock price. Amber Enterprises as well, the sales have now dipped to about 927 odd crore rupees. The margins as well have dipped to nearly about 6.5% from the earlier almost 8% comparable in the first quarter. So that really is weighing heavy on the counter. There's of course Credit Access Grameen as well. Strong numbers. Asset quality has shown an improvement. In fact, we had the management as well earlier on the channel speaking with us, and they're pretty confident of maintaining these kind of numbers even going forward. In fact, they've guided for a very steady ROA, that of 5.4 to 5.6, and ROE as well of 24 to about 25 odd percent. So that stock, of course, is holding out well. And then, of course, there's BSE as well, a couple of brokerage upgrades coming in. We will talk about that in greater detail as to what the brokerage notes actually entail and why this upgrade coming in. But Investec has put a buy with a price target of 2140, IFL 2000 rupees, a buy target. So both, this particular stock is holding out very well on account of these two brokerage notes. There's also Ipca Labs as well, wherein the US FDA has classified their Atlam API side as a VAI. So that's another stock which is in focus, holding up 7% as we speak. But brittle for the markets, to say the least. Kunal, do you still hold by with that view that you had earlier today, that up until or around Diwali, we should get back to the 20K mark?
I think post Diwali is what I said, and I still believe that maybe this could be the final round of selling pressure for the indices. It doesn't mean that everything's going to end today, but then I would believe that maybe it could be the last leg of selling pressure, something which was due for the indices over the last couple of months. So the mid-cap index actually topped out in the month of July and August, and from there, for the first time, you're seeing in the last 2 or 3 days that the pressure is more concentrated towards the mid-caps rather than the larger cap names. So in fact, the indices are doing just about 0.5% to 0.25 to 0.5% in terms of losses, but the losses in mid caps and small caps is pretty much on the higher side today. So I believe that maybe this could be a trend where we may expect the mid caps to underperform significantly as compared to large caps.
Naresh, do you think much like today, it will be globally linked sectors like metals which are going to weigh heavy on the markets, or would it once again be banks which is looking like the weakest link?
The change, it is banks which are not looking the weakest link. The large cap heavyweight private banking names are holding on. The bank Nifty is down 100-150 points on a day when the mid cap and the small cap indices are down 2%. And the Nifty is down 0.5, 0.7%. So it seems like a bout of profit booking and some bit of a healthy correction going on in small caps and mid caps. The only case wherein the mid cap index has broken the recent lows, the last shakeout lows made in the last 2 months. So we could see a little bit of a extension on the correction as such. So time to wait it out, let the correction continue, and then maybe look for reversal signals. Today is just the first day. And on the Nifty, 19,200, 300 remains the support. So for now, time to take some chips off the table in terms of leverage and wait it out. Let the market settle on the lower end and look out for reversals. Globally, also, what we are seeing is we are back to the same lows for US indices, European indices. And whether we see a further sell-off or take a pause here needs to be seen over the next few sessions.
Vinit Bolinchkar also joining us on the show. Vinit, do you concur with the view that it's time to take some chips off the table, book the profits that you have seen, the massive gains in the mid-cap and small-cap over the last 3-4 months, or time to hold on and in fact keep your buying and shopping list ready?
Actually, I concur with the view that it's time to take the chips off the table. Reason being that this melodramatic geopolitical situation that has been created is not wishful. It will be only wishful thinking if we think that it will hush away in a few days' time. I think there is substantial kinetic action that has taken place, and knowing the character of the affected country, you can be sure that they will not stop until justice is served or their goals have been met. So I believe that it could be a long run out incursion, and if it plays out the way Ukraine and Russia played out in 22, then we are going to be in for a prolonged correction taking place in the market. So I guess these levels of 17,250, which were the previous low which took place, should be your critical level to watch.
250 is still quite a far away. You think we'll retest those levels, Vineet? And if history is anything to go by, whether it was the Ukraine-Russia war or even the earlier geopolitical situation, India had actually managed to outperform quite a bit, and from those levels we have run up quite a bit significantly. So wouldn't this be one of those opportunities?
So it can be an opportunity, but we have to understand that the Middle East is the keg of the oil markets. And already the premiums only for transportation have gone up through the roof. So, oil, it is one of the very important oil lanes that take place because most of the oil flows through these regions. And even if you get dollar discounts, which are significant, just the sheer cost of transportation can nullify these things. And, and if a war breaks out where more than two parties are involved, because the posturing by the different players in the theater are very, very aggressive. And until, something substantial clarity emerges how the things are flowing, one should be very, very cautious. And in that uncertainty, markets don't like uncertainty. Markets can sell off.
Okay, let's pick up on the case of Kotak Bank. And I think more than the earnings, it was the appointment of the new MD and CEO outside of the Kotak Group, not someone internal who was elevated to that post. That is something which was really the talk of the town all through the weekend. Today as well, the stock started off quiet and then from there it tumbled, currently lower by about almost 1% odd. And I say tumbled because Friday, remember, it was a gainer. You didn't see any big shake-off when the stock started off trade today. But yeah, Ashok Vaswani's appointment has clearly brought some amount of weakness in the stock. I mean, it could very well be because of the overall market mood as well. But Vinit, how are you reading into Kotak Bank? You think there is a chance that this finally, 34 odd month of underperformance, a consolidation in the stock may actually reverse?
The results are quite encouraging, and we did not see that much of a margin compression, and I think it is mostly done with. So definitely this stock looks to be at a level where one can go and nibble at this stock.
Taken. Naresh, what's the chart check suggesting on Laurus Labs as well as BSC?
So Laurus Labs has given a short-term breakdown. For the last almost say 3 months, the range for the stock was roughly 380 was the low and 410, 415 was the high. Yesterday, post numbers also, the stock made a top around 410, 415. Today, we've broken down below 380 levels. In that case, you would have a target price closer to 330 to 350 levels on the short term. Technically, the trend has been down for quite a period of time. We did see some bit of a recovery from the lows in April, May, but again, a fresh breakdown here. It's a sell on rise with a stop loss at 400. So any bounce back from here will continue to see selling pressure. BSE has overdone in the near term. The stock has gone up from 400, 500 in March, April, all the way to 1500 to 1700. Even in the last, say, from September lows of 1150, 1200, the stock has done quite a bit. Stretched in the short term, could be making a short term top and getting into a sideways pause. Not looking like a steep correction from here, but could get into a sideways move for the next couple of weeks at least.
Bring up the stock price for Paytm as well. And, post its earnings, post market hours on Friday, you had CLSA come out with a buy. They've upped the target price to now $1,200 in Paytm. They're saying that there's been good GMV growth because of the new Soundbox variation. They've hiked the EBITDA estimates as well to about 12 to 13% for the fiscal. And the con call takeaways as well, wherein the management has categorically stated that, payments business is expected to have a few tailwinds in the next few quarters. They're expecting net payment margins at about 7 to 9% of a range going forward. And they believe that almost 1.5 million devices can be added on a quarterly run rate basis from here onwards. Vinit, just wanted your understanding on Paytm and how this new evolved Paytm is going to pan out for the shareholders.
So we are very constructive on this stock, and we believe that the growth story has just emanated fundamentally. And with the kind of results that they have put in, it's going to be a kind of a mini Bajaj story playing out over the next few quarters, and definitely a stock where I would like to be a buyer.
Fire on some of these small lenders, Credit Access Grameen, Poonawalla FinCorp, quarter after quarter, we have seen that the earnings growth has been rather stellar. Vineet, the question is to you.
Yes, Credit Grameen is a excellent quality franchise, and they've beaten the markets, and we believe that they will continue to do so.
Point taken.
As far as Poonawalla is concerned, I think that the numbers of Poonawalla are not as hunky-dory as we would have liked to expect it to be, but definitely a very reasonable number, and it should continue for the next couple of quarters too. But a trifle disappointment for the markets, which are expecting higher numbers.
In fact, since we are talking about Credit Access Grameen, listen into what the management told us earlier today.
Higher base, we believe that our growth should be little moderate than last year. The annual growth of last year was 27%. So therefore, we thought, and then our based on our own internal feedback and the stage at which we are here, we thought it would be prudent to grow little, moderately at about 24-25%. So we have not changed the growth guidelines, but we have changed some other key parameters in financials, like ROA, ROE, cost to income, as well as the NIM guidance. All these guides have been made upward after the Q2 results. So cost of borrowing is at about 9.6, 9.8%, and this is quite good price for us actually. And I think it is getting into a zone where it will be stable going forward. So we guided about 12 to 12.2, but I think we upgraded in this after Q2 by almost 60 bips. It is 12.7, 12.8% NIM, which is stable status we should be able to give, which is quite good, which can result into almost 5.5% of ROE and close to 24-25% of ROE.
Okay, in fact, let's address some of these stocks that we were just talking about. In Laurus Labs, the fact that it's down a good 10% after the miss in the second quarter numbers. Let me take it across to Vinny and find out what exactly led Shrishti and find out what exactly led to the drag in the earnings, although they actually maintained their guidance. Shrishti?
Yes, Laura Slab has been down 10% in trade today, and that's after a fifth consecutive quarter where the company has missed the earnings estimate of the street. And on the consensus, if we'll see, then all the brokerages are not very gung-ho about the stock and the growth trajectory going ahead, though the company has maintained its FY24 growth guidance. But the segmental performance outlook is not that, not giving so much of confidence to the analysts. So there has been no significant upside or target price uptick by these brokerages. But firstly, let's talk about the numbers then. It won't be good to compare the numbers on a YY basis because the base was quite very high on the back of a one-time order that was there in the first half of FY23. So sequentially itself, though there has been a slight improvement, but the margin specifically, though the street estimates was around 17%, 15% is what the company clocked in. And specifically their API division, which contributes over 50% to their top line, has contracted 7.5% onto the sales figure. Talking about their profitability, that has been impacted by operating leverage as well as higher interest costs as well as higher depreciation cost as well. But talking about brokerages then, firstly let's have a look at Jefferies' note where they maintain their underperformed rating. They highlight that the weak CDMO performance, commercial scale validation supplies for the animal health product has been started. No guidance provided for FY24, but they do expect that second half of FY24 the margins could be a bit better. But Kotak maintains a sell with the target price of just 270 rupees. They say that this has been a big miss across most of the segments in Q2. Still remains a downside risk to the lower assumption of their synthesis sales segment specifically. Motilal Oswal do reiterate their buy with a target price of 460 rupees. They say that the earnings decline due to the high base, pricing pressure, lower volume offtake in the ARV segment over the last 12 months, and they also say that the earnings expected to decline 37% on a YY basis in FY24. And lastly, Antic believes that the transition from ARV to non-ARV segment will result in a challenging FY25 as well. They expect the EBITDA margin to stabilize around 23% in FY25, but they do remain concerned about the stress on the balance sheet because the debt to EBITDA level is around 2x. So that's why they are not very gung-ho about Laurus Labs. So these are brokerages highlighting, and the stock is trading 10% down in trade as of now.
For that, but shifting focus, IGL was the other stock which is down 10% on Friday. Before that too, it was seeing quite a bit of pressure, and that was all because of the change that was being proposed as far as the Delhi EV transition policy is concerned. Now what my colleague Prakash is picking up exclusively suggests that sources from IGL are saying that Delhi government's EV policy is being overhyped. The policy was already under discussion for the last 2 years, and the impact cannot be seen in isolation. Prakash, what is actually IGL's view and what could be the implication as per them?
Yes, we are learning from our sources that the impact of Delhi government's EV policy on IGL is overhyped. Sources are saying that this policy is not new. In fact, it was under discussion for last 2 years. Therefore, it is not a sudden development. In fact, it was anticipated. However, sources are not denying the fact that yes, there will be impact on IGL, but not at the magnitude it is being stated. Sources are saying that this impact of this policy shouldn't be taken into isolation. Yes, there will be impact. One cannot deny the fact, but that would be limited to 15 to 20% of the overall business after 7 years. Other than that, we are also given to understand that one should not ignore the fact that IGL's city gas distribution business is expanding. Its CNG, PNG business is now growing outside Delhi NCR. It has increased to 30 districts and now expected to increase further. Other than that, one important factor is there should be taken into account. The sources are saying that the IGL is diversifying its business portfolio from battery swap to EV charging station to LNG business. These are a new focus area. Sources are also saying that with expansion and diversification plan that the GAIL has adopted, have potential to mitigate the losses due to this policy going forward.
Thanks, Prakash for bringing us that latest story. So IGL is the stock in focus on account of that, continues to reel under pressure. Vineet, on that note, we let you go. Thanks so much for staying on with us and talking to us about whole host of stocks. In fact, we'll continue that discussion, but after taking this very short break.
अब क्या देख रहे हो पापा? तुम कहते हो ना कि
Trades right here in 18 now pretty much struggling around the lows of the day, so still down 151 points for the Nifty futures right now, well sub that 19,400 mark for the Nifty as well. Kunal, let's just revisit your strategy on the index before we move forward. Where does the next support come in, and B, do you actually see weakness getting into expiry later this week?
Yeah, I think of course this kind of a selling will have an impact on the FNO series and the rollovers for the next series. That's bound to happen because over the last 1 or 2 weeks the markets were still settling into a trading range. But today's sell-off, which is more broad-based, I think should have an impact on the FNO rollovers. Of course, the data is something which we'll wait out for. And this being a truncated week would also probably be one of the major reasons why there should be more risk-off rather than trying to buy the dip and trying to be a bit more adventurous into buying this correction.
Okay, so since we're talking about risk off, let's talk about the asset class which is best placed in that kind of environment. And we have Aditya Birla, which has actually launched the open-ended fund of funds scheme investing in units of ETFs focused on US Treasury bonds as well. Kaustav Gupta, the co-head for fixed income Aditya Birla Sun Life AMC, joins us in the studio to talk to us about just that. Kaustav, hi, good to have you on the show. Thanks so much for making time and coming down.
Thank you, ma'am.
First up, explain to us why one should invest in this.
So look, the fund that we are coming out with, it has 3, I will say, USP to it. First one, that as an asset class, one should invest in USD at this point of time. Second, from the ease of investment. And third, it gives you some bit of diversification in the general risk off scenario that you just spoke about. Now, when I'm talking about that, why USD at this point of time, look, the idea is that when you invest in any asset, you want it to be cheaper, which is way it is. In last 18 months, bond markets, they have seen one of their worst period in last 50 years. So from a valuation perspective, they looks relatively cheap. Second, at margin, we do think that the monetary policy hike by Fed is now started to work on US markets, in the sense that when we are looking at the commercial bank loans, we are looking at the money supply growth, when we are looking at their mortgage rates, when we are looking at their labor markets, everything is pointing to a slowdown at margin, which means that we do expect that Fed is very near to its peak rates, which makes sense that to invest in USD. Historically, whenever Fed has stopped its rate hikes, usually plus minus 1 month, USDs has also peaked in. The second is ease of investments. When I am talking of ease, one can invest directly in these USDs as well, but if you are investing in USD directly, there is a cap that how much you can invest, and it is also subject to some bit of a tax collection at source requirement at the rate of 20%. That makes it little inefficient. If you are investing through mutual funds in ETF route, what it does is that entire regulatory filings is taken care of by us, and also you are not subject to any LRS cap. And of course, the risk off environment that we are talking about, and USD is known that it is a good proxy if you are looking to invest in a risk off environment. So apart from gold, USD makes sense.
Sure. But Kaustav, when you invest into mutual funds, that's not for an in and out positioning, right? You stay put with your mutual fund holdings. So is this that long-term investment that you can stand by with?
Yeah, it's good for both set of investors. It's not only tactical the call that we are trying to give, but also from a long-term investors. Now, at this point of time, across the board, USDs, they are giving you yield closer to 5%. Remember that despite so much of talk, USD is still accounting for 48% of your reserve currency. And in that, it is a funding currency for the world. And a funding currency, irrespective of tenure, giving you 5%, it's a reasonable allocation for the long-term investors as well.
Sure. So tell us a little bit about, as a fund allocator, how much quantum of your fixed income portfolio should be invested into a scheme like this?
We have a cap how much we can invest.
Sure.
For example, in that route that we are talking about, regulator has given as an industry $1 billion cap, and as a fund house we can take just $250 million, right? So that's a very small limit which is available, a window of opportunity if you are looking to look other than your LRS limits. But per se, I would say that whatever is your fixed income portfolio, at least 10% of that allocation should be through this route to make max of the bunk.
Okay, so 10% of the fixed income allocation can be put through this. But talk to me about the risks as well, right? What are the monitorables that one should keep in mind when you are investing into a ETF like this? Because this is something we don't easily or normally associate ourselves with, right?
Yes. So in a fixed income, as you rightly said, that there are three risks: liquidity, credit and duration, which is also known as market risk. Now UST, no one questions about liquidity because it's the most liquid market in the world. There is no credit risk per se. The third risk, which is duration of market risk. So if Fed turns out to be a lot more hawkish than what is being priced in by the market. Now when I am talking about priced in the market, remember we were talking 18 months back that rates are likely to be lower forever. Now what is priced in by the market is rates will remain higher for longer. So a lot of thing is already in price. Now this being an offshore market or offshore instruments, the fourth risk I would say at margin involves is the currency risk. Now again the argument says that in last 10 years usually dollar INR has depreciated by 3.5%. What we are assuming is that incrementally INR will depreciate by just 1.5 to 2% in order to ensure that we remain competitive. So if you have from a long term allocation perspective that takes care of potential walls, it is available at cheap prices. We are near to the rate hike which is being done by the Fed, and you have an added advantage of diversification in risk off, especially through currency as well. It makes a lot more sense both for tactical and long term investors.
And what about your own view with respect to investment in US market right now, US bond market that is, versus the Indian market, because the spread between the Indian bond as well as US bond has narrowed quite a bit, right? What's your take on that, of how the way forward will be?
Look, again it refers to the technical part, which is a valuation part of it. As we speak, the spread is too narrow between USTs and Indian govies. As a matter of fact, last 20 years average govies, Indian government bonds, they have traded closer to 7 to 7.5, and today also they are in that range. But average USTs, they have traded closer to 2.5 to 3, and they are available at 5, which means that US treasuries, they have lot of room to move downward compared to the RBI giving or enabling to ensure the financial stability Indian government bonds, and which is why from that perspective as well it makes sense.
Okay, Kaustubh, great to have you on the show, and once again good luck for this scheme. An interesting proposition at that, and seems like good timing too. We're going to take a very quick break on that note. We're at the session low, so let's try and track markets on the other side of this break.
We were holding on to 19,400 just 30 minutes ago, and look at the last 10 minutes, and you should pull up the candlesticks because that will tell you the extent of those red bars that have suddenly come on the markets right now. 300 was broken on an intraday basis almost, and that's the screen that we are staring at. Bank Nifty, which was holding up okay for most part of the trading session, has also seen a lot of those red bars. Part of it is of course on account of the global factors. So right now if you look at the European markets, they are down anywhere between 0.5% to 1%, and the Dow futures too have worsened quite a bit. When we started off the show, the Dow futures were down almost 40-50 points. Right now we are staring at a cut of almost 140 points. So there has been an additional decline on the futures as well for Dow, and that's what we are witnessing right now. Nasdaq too down about 70 points. Nikunj is also with us in the studio. Nikunj, would you say this is something that markets should have expected, or this is coming in as a bit of a surprise and a shock?
What do you think?
I'm a bit surprised by the ferocity of the sudden move.
Okay, let's understand why this has happened. See, global cues from last couple of days were slightly sticky. Last week Nifty fell by just 1%, whereas rest of the market or rest of the world fell by about 3.5 to 4%. So you obviously had this global catch up which you had to do on the leg down rather than on the leg up. So I think we are simply normalizing to what the global setup is. Then let's look at the world. The world has not become a place where you can decisively say that okay, the war issues are over, or the uptick what we saw in crude or the spike in bond yield, that is behind us. For me, the biggest moving part I think is the US 10-year paper, which is at 5%. Historically, when the bond yield paper has gone above key levels when 1 became 2, 2 became 3, 3 became 4, and now 4 has become 5. That has always led to sharp adjustments and bout of FI volatility. The same bout of selling we saw when bond yields had gone from 3 to 4. The same we are seeing when these landmark numbers, they go from 4 to 5. So that's the FI selling which is causing this selling stampede. C, there are just no triggers in the market which will generate upside momentum. Banks, well, we know they would be good. So market is saying thank you. IT, nothing large has come from them. If at all, FMCG companies, HUL, ITC, Nestle, they've come out with numbers, they've not given anything very rosy or anything great or gung-ho. So this market in a sense was hunting for trigger. Valuations are rich. Global selling has intensified, and the uptick in bond yield is something which is leading to what could be called as a knee-jerk reaction. I think we are in that phase of the market where I will stick my neck out and say that you should not buy the first fall. It's very easy for me to say, okay, you know, nothing changes in the long term. Of course, nothing changes in the long term, but if you're looking at tactical idea, I think we are in that phase of the market where no action could be the best action.
But Nikunj, this is nothing new, right? As in last week as well, we had the IT earnings. It's not that the US yield went suddenly from 4 to 5. No, we knew it was at 4.7, 4.97, 4.96 for the longest time. The war has been there for almost 7 to 10 days now. Why today? Because this morning when we all came in the morning, and I think you'll agree, we weren't expecting a level of 19,300 when we started the day, right?
Not so sharp.
See, what happens typically is that you must realize that we live in an AI-dominated world by algorithms. Now, these algorithms are programmed around 200 DMA. These algorithms are programmed around bond yields which are at pivot points. So like I was saying that when 2 became 3 in the uptick post-COVID, we saw some selling by FIs that time. When 3 became 4, we saw similar kind of a phenomenon. 4 has become 5. See, bear in mind that the bond yields had become almost sub 1% at the peak of COVID. 1.5, 0.75 becoming 5, that's like a 400% jump. And that will lead to financial adjustment in the near term. And then beyond a point, FIs, they continue to sell. DIs will also say, okay, what's next for us? So I think this what's next question is something which in a sense is also having an impact on selling. But I think it's a bull market correction. By the time we'll realize that it's savage and swift, it'll be over.
Yeah, for now, of course, it's pretty savage and quite ruthless. We're well sub the 19,300 mark. Flickered in and around that in the last 10 odd minutes, and now it seems like a persistent fall. Devin Choksi as well joins in on the show right now. Devin, hi, afternoon. This is not the way you would want to have, headed further into the festive season with this kind of a market. Will you think soon everything is going to abate? Because, like we were just contemplating right now, the reasons were already there. Why this sudden knee-jerk reaction then?
So, Aisha, good afternoon. Well, I guess I think Nikunj has summarized aptly, I think, the entire subject about how FIs are taking out the money. And in the domestic market players, I guess I think the situation is basically they are writing losses at this point of time. And as a result of it, they are required to sell some part of their portfolios to pay off the sharp mark-to-market difference which is coming up on some of the holdings, including, I think, some of the mid-cap, small-cap companies. Over there, the fall has been quite sharp and acute, and I think a large percentage fall has come. So certainly, I think we are basically going to see this pain continuing, and I think this particular fall, definitely though people have a lot of money to invest in, but this particular fall would probably, I think, will have to be waited for some more time for a variety of reasons. One among them very particularly would be how exactly the domestic investor stabilizes on his losses, because I think the options market, even putting into the derivatives market, the amount of money that he has to write check for the mark-to-market will probably, I think, put pressure on the market. On one side, the FIs are not there in the market to buy. The domestic investors, mutual fund is selectively buying the cash market stock, and the traders are writing down checks for the losses that they will get. So this is where probably I think we are going to see technical adjustments continuing in the market for some more time.
What's worsening it perhaps, Nikunj, is the fact that you don't have any FI cushion, right? I think barring that minuscule of a figure that you had on Friday evening, they've been consistent sellers.
So Aisha, Indian markets thankfully is no longer this one-trick pony where you would look at a fair weather friends and say every time there is bad news.
It's not, but had they been buyers in the last 1 month, you would have some more cushion.
Of course. So now you could ask yourself, is that they were sellers, will they continue to remain sellers, and will they increase their selling quantum? See, the story is very simple. DIs are buying, retail is buying, FIs are selling. Now, how much more can FIs sell? I don't think they will come back in a hurry. looking at the bond yields and the global setup. You will only come back when the dust settles down or valuations become attractive. Then retail guys would say, okay, I don't care. I care about the mid and the small cap stocks. They are doing okay. And then the HNI brigade, where sliver of the market is actually cheap now. So whenever you go in a market, in the near term it's sentiment, which is slightly sticky. In the medium term, it is liquidity, which is getting difficult to predict. And then in the long term, it is earnings and it is the trajectory of the economy. So 2 out of 3 things are comforting. But the short term, which is a function of sentiment and compulsion and algorithm-based stroke technical selling, that is not with you. And it's a brute force of selling which will break the back of the market. So you should not be in a hurry to buy. Kya jaldi hai? Let it settle. I mean, there is no point in trying to be a compulsive buyer. That's my limited point.
Yeah. Devin, what's the strategy here? I mean, try and take some chips off the table, protect your portfolio, or do you think it's time to go contra? Because, unfortunate as it may be, the stock returns are where there is growth and growth visibility. The contra call has to be then taken in the bottom-up stories, which are not performing right now. I mean, IT, chemicals, some of the individual private banking names.
So, in some of the fundamentally growth-oriented stories where we are maximum convinced, I think we have been waiting for this kind of a fall to come in the market because this fall is not going to, I think, take away the program of this company delivering results. So, frontally, I think the values are going to become cheap if that all this fall continues, and that would be the time to buy. Fortunately, in our funds and with our investors, I think we have kept a significant amount of cash in the portfolio. This kind of a correction definitely, I think, brings up the opportunity to buy. So we may not buy all at a time, but I think selectively in some of the stocks, I think we would like to buy in this particular fall.
Sure, Naresh, what's your view? What's the best tactical trade that you would suggest at this point of time? Index level, anything stock specific?
So on an index level, cut the long positions, wait for the markets to correct a lot more. Let us check whether it breaks 19,200, 300 mark over the next few sessions as well. So the tactical traders to create some bit of short positions in specific stocks. So something like a Birla Soft or some of the IT names which are yet to correct. They've done really well. So there could be some correction over there and wait out. At times doing nothing is a good trade.
Kunal, 19,273. Same time last week, we were discussing that the path of least resistance is on the upside. Has that reversed to the downside now? Are we looking at more pronounced downside? And in this selling, it could be 18,000, sub 19,000, 18,500. Are things looking dangerous now?
Yeah, things are looking critical for the indices, Nikunj, because what we've done today is we've managed to break below a major support. And I call it as major support because it was formed by a series of 4 gaps which was created at the 19,300 mark. And that is what we were waiting out for over the last 1 month. So even last week, for example, when the Nifty closed, we were almost at 19,500 approximately for the Nifty. And for the last 1 month, we've been just fluctuating into this band of 19,300 to 19,800 broadly. So which means 19,500 was more of a pivot for the Nifty. I think after today's break of 19,300 mark, and seems like we would probably be closing below this level, this could probably be a decisive breakdown for the index. And even if you look at the range of this 500 points for the index where we were fluctuating in the last 1 month, even if that range gets replicated on the downside, we could be looking at 90,300 minus 500, which is closer to 18,800 for the index, maybe in the next 1.5 week.
And Kunal, banks looking the most brittle, or would it be some newer sectors like today you're seeing metals crack the hardest?
So in fact, for a good part of the day today, banks were not as weak. I think except for the last half an hour, last 1 hour, where the selling has been a bit more pronounced into the banking stocks. It's actually the metals which have fallen by more than 3.5% and some of the other smaller cap, mid cap names. In fact, the mid cap index in the last 2 days has also corrected by more than a margin of 5% odd broadly. So I think the pain is more towards the mid cap end of the market as well as into few of the high beta sectors. I don't expect Bank Nifty to correct very, very sharply because Bank Nifty is already retraced towards the 200-day moving average. So just to give you a brief understanding, the Nifty, the 200 DMA for the Nifty is at 18,600 and we are almost at 19,250 for the Nifty, which means we have a cushion of 600, 650 points. Bank Nifty is already corrected to those levels of 200 EMA.
Okay. Tell us an example. Give us an example of your top 2-3 holdings or 4-5 holdings which you would be only looking at adding. Now it's a 5% decline, 10% decline. That's a judgment call and that's a market timing. But you are absolutely clear that this decline is something you've been waiting for, and you should be smiling because the decline has come. Has rahe ho Devin bhai, correction aa gaya. It's only market when prices go down, investors they feel happy. Navratri spirit थोड़ी तो होनी चाहिए. चल हंसो.
Yeah, Nikul. I think थोड़ा तो ऐसा है कि I think in this particular market ये जो fall है, we feel that I think this particular fall is basically giving us the opportunity to buy into some of the stocks I think which we are holding. We have been holding companies like Bajaj Finance, Bajaj Finserv. We've been holding companies like Reliance and Reliance Jio Finance, I think, after the demerger. So all those kind of companies, including Tata Motors, they've been holding this kind of stocks. And any corrective fall in these particular stocks, we feel extremely confident to buy further into the portfolio from these particular companies. Some of the at current levels, I think the upside is limited. But moment this particular fall came in, and if this fall further accelerates, then possibly I think you are likely to get it. If you end up getting, I think at capitulation level, the stocks probably are likely to get 15 to 25% kind of upside in the next swing, which happens I think in subsequent course of time. So we would be comfortable buying and adding these companies into our portfolio because we feel fundamentals are not changing, and on the contrary, they remain stronger enough to I think bring the portfolio up from this point.
Yeah, the fundamentals are not deteriorating, and that is something that you can also fathom from the kind of 10-year moves that we have seen. And Somit has helpfully culled out this data that from October 9 till now, there has been an increase of almost 22 bips when it comes to the US 10-year yield. So, when you stare at around, 9th of October, the US yields were perhaps around that level of 4.75. That's breached 5% now. Indian, yields, if you look at it, they have hardly changed even 1 bip right now. So, from 7.38, they only went up to 7.39, and the UK 10-year has also seen a sharp move in that time, up almost 26 basis point within a matter of 20 days itself. Devin, what does this tell you? That, of course, the Indian economy is much stronger, and ergo, you should look at the domestic consumption themes?
Nisha, I think if you practically check with every company, I think they are all basically sitting on a very huge amount of, I think, business for execution. Be it in the engineering space, be it in the service sector, or even those sectors which are primarily connected with the primary sectors. I think everywhere probably you are seeing the huge amount of order book in the place and the demand situation continuing. I don't think that this demand situation is going to go away in hurry in next 1 or 2 quarters. So that is one area where probably I think you feel more comfortable adding stocks in your portfolio. Second most important aspect is that I think so far so good. I think the inflationary pressures have not affected the margins of our companies. Though I think because of the values not going up, the sales have remained tepid, but the margins have remained actually strong. So we feel confident that if the input cost is not going up in hurry, then possibly I think the companies would be able to maintain the margins. So we are not very sure about the fourth quarter, how this particular crude oil saga will play out. If it indeed becomes dirty, then probably I think we'll have a challenge in the fourth quarter. But at least in third quarter, the results are likely to remain relatively stronger for most of the companies as we see.
19,270 and now even dipping below that level. Naresh, let's revisit your Nifty strategy, given that tomorrow, unfortunately, is a trading off and then you've got expiry on Thursday.
So stopped out on the longs, not taking a short here. The risk reward is not great. So no trade is the strategy on the Nifty at current prices.
Okay, let's take in some BTST ideas as well, or is it going to be STBT, Naresh?
So a mix of sell and a buy. Sell on Birlasoft, the stock seems to have topped out in the short term. Stop loss at 537, target price of 515. Second is a buy on UBL, which has been trying to hold on through the whole day. Stop loss at 1620, target price of 1670.
What about your strategies?
So it'll be 2 sell calls. First one is a sell on trend. The stock seems to be on the verge of breaking below major support of 2000. So targets of 1900, stop loss at 2050. And Tata Com is also another stock which has fallen very sharply today, broken below the 50-day moving average. Expecting a second round of correction into the stock price. 1580 as a target, stop loss at 1660.
Okay, a lot of blue chips are actually taking it on the chin. LTI Mindtree down about 4%. You also have Adani Enterprises down 3.5%. UPL, some of these metal names, Hindalco, JSW Steel. So a lot of these global facing names, whether IT or metals, are the ones which are seeing sharp cuts. And not just that, from the broader markets as well. If you look at the F&O vertical as well, a lot of stocks like PVR, etc., Indiabulls Housing are not doing well at all. SJVN, the darling of that, entire mid-cap rally, suddenly seen a cut of almost 13%. BEML, Star Cement, RCF, these are some of the names which have easily seen a cut of almost 10% today and no incremental news flow as such. Just quickly, let's take stock of the financials as well, Devane, because that was the space that was underperforming. Now, do you believe that given the entire, sentiment has reversed, maybe it's time to start looking at banking positively because the rest of the sectors are fairly overvalued?
Well, I think banks did not participate enough into the rally, and certainly I think majority of the banks have remained comfortably placed on the valuation front as well. Not forgetting that I think they are having the growth in their AUM, not forgetting that they have been able to attract the deposit at a lower cost and also maintain their margins. Given that situation, I would think that I think correction in the stock prices of some of the corporate banks, this could be I think a buying opportunity at every fall. Maybe I think one will have to selectively keep building the portfolio because generally these stocks are priced to perfection. And in a boom market, I think you don't get the headroom. Here today, after the correction, you might start getting some headroom in some of the select names like HFC Bank and even for that matter ICICI. We feel that I think any correction in the price, I think these kind of companies are worth getting into the portfolio.
Okay, while we're going to be off on account of the trading holiday for the Shara, there's going to be Microsoft as well as Alphabet numbers, and that's going to really weigh heavy on the US market sentiment, as also, of course, predictably so, the NASDAQ too. In fact, the pre-market futures right now in the US are not looking that great. You've got a 200-point fall on the Dow futures. S&P 500 futures are currently down 0.6%, and it's a 121-point downtick that you're seeing on the NASDAQ futures as well, clearly indicating that tonight as well, it's going to be all a sea of red when it comes to at least the US equities. Europe as well has started off on a back foot. In fact, within minutes, you've seen quite a bit of drift down come in for the European markets, much like our markets. They started off just about marginally soft, but now you have a 150-point fall on DAX. FTSE is down nearly 1%, 0.5% down for CAC, FTSE MIB as well soft, and Stock 600 as well, which is lower by a good 1% or so. So quite, swiftly, we've given up that 19,300 mark as well in trade today. And from the top of the day, I think the ticker is a telltale sign of how damaging today has been. Kunal, it's been a 300-point fall almost.
Yeah, 300 points. So, it was as if that the party got over some time back and the bill was sent today to everyone. So, I think it's more of the mid caps and the small caps in the market breadth, which is holding up pretty well over the last 1.5 odd month, even though at a point when large cap stocks were under pressure, and we were consistently discussing the likes of Reliance as well as HFC Bank being under major kind of a selling pressure, but the market breadth still remaining stagnant. I think that part has now reversed completely, and now we are seeing the market breadth more or less getting in line with the larger cap underperformance. So this could probably be a start of a trend on the downside. So we'll wait out for maybe another day of confirmation, but now 90,300 being broken is a point of concern for the markets over the near term.
Okay, point taken. And that bill which we've got of that party is quite hefty, clearly, and a lot of people are paying the price, because if you look at the mid-cap and the portfolios, they are the ones which are bleeding today. So yes, the index has also seen a cut of almost 300 points, but I'm sure the portfolios are seeing it perhaps worse because the individual names are seeing a lot of pressure as well. Just shifting focus in terms of the constituents of the market to see which are the major pullers and draggers at this point of time from the broader market. There are outliers. So Credit Access is still high by 8%. BSE is holding out. Ipca Labs, Rainbow, Children Hospital, MedPlus, they're all doing okay in an otherwise weak market. Even Aurobindo Pharma is going home with a bit of a green tinge. Devin, your sense as far as the pharma space is concerned, is there any name particularly that stands out as a buying recommendation?
I have looked at, I think, some of the results, and I think one of the interesting one which I found out was Loras. Though I think the company has made on a year-over-year basis a significant fall in the profits, but on a sequential basis, I think the jump has been quite sharp as far as I think the numbers are concerned. And that makes me believe that I think probably the worst is over for the company and situation maybe started turning slightly better. At least from the commentary with the management, I find that I think the underlying tone is becoming more and more confident. This could be the time wherein I think you take some contra decisions and contra buy actions in some of the quality companies where the fundamentals remain solid at the back. But for a reason, I think they have not supported the company in the current workings. So for which I think one could possibly getting at an opportunity. In fact, I do believe that many of the pharma companies, including Divis, would be, I think, a right choice to make in this correct fall, I think, which is corrective in nature.
Well, quite a damaging day. Everything from a Loras Labs, which fell about 7.5%, Hindustan Copper 7%, India Cement 7%, Idea nearly 7%, ABFRL, which fell almost 5.5%, Taracom down over 5%, RBL Bank down 5.25%. BHEL down 5%, Balrampur Chini, AB Capital, and then of course, the metals pack sectorally fell the hardest. Nalco down 4.5%. PVR as well saw a fall of over 4%. City Union Bank, NMDC, SAIL, Piramal Enterprises. I can just go on with the list of losers. It's pretty endless. So LTIM, IDFC, L&T Finance, JK Cement, Adani Enterprises, they've all had quite a steep fall. Even names like a DLF, Canara Bank, IRCTC, some of the momentum chasers, they as well have had it pretty rough today. All sectors have managed a weak close. The relative outperformers were maybe pharma, automobiles and FMCG. Bajaj Finance managed to hold on to its gains. It's almost a 1% green tick that you close the day with. On the futures and just mildly positive on the spot. M&M, Nestle, Apollo Hospitals and IndusInd Bank were the relatively resilient ones, although IndusInd as well closed in absolutely flat for itself. So yeah, that's pretty much it. Ipca Labs, Balkrishna Industries and maybe UBL being the only shining stars today.
But I think more than Indian markets, you need to be watchful of what's happening across the globe, because when we'll be shut tomorrow, it'll all depend how that US 10-year performs and whether we see a bit of a relief rally or not in the US markets, because for now we are expecting a sharp slide. European markets are already down to the lowest levels of this year. So where do we go from there? As well as the US markets have seen quite a bit of slide, and the risk-off rally rather has really continued. Gold being close to that $2,000 per barrel mark, and the dollar index to around 106, 107 does not really support the sentiment. But it's holiday tomorrow, so let's bring in some festive cheer. It's of course Dussehra. So here's wishing from the entire ET Now family a very happy Dussehra to everyone.
सुरक्षा वही चुनो जो सुपर हो, इसलिए मैंने लिया है SBI जनरल